Hi, Martin Turner here. This week we complete the second of our 2 lectures on predicting the future. We start by looking at forecasting net operating assets, one of the key accounting drivers of cash flow and economic profit. We then look at the issue of forecast horizon, what we do when we cannot focus with some degree of confidence further into the future. And we check out 2 great short videos on forecasting net operating assets and forecast horizon. We discuss some of the key issues concerning how we can use financial statements, which are a record of what a firm has done in the past, to help us focus on the future of our firm. And we discuss whether it makes sense to focus on the economic and business drivers of our firms with all the judgments and qualitative assessments this requires. And we discuss what barriers we may face to use financial statements to engage with the realities of our firms. First, let's look at forecasting net operating assets. Well, welcome everyone. I'm Martin Turner here. This week we complete the second of our 2 lectures on predicting the future. And what we'll do is we'll first start by looking at forecasting net operating assets, which is one of the key accounting drivers of cash flow and economic profit. And then we'll have a look at the issue of the forecast horizon, which is that what do we do when we can't forecast with any degree of confidence beyond a certain point? What do we do beyond that point? And we'll also be looking at 2 short videos on forecasting net operating assets and the forecast horizon. And we'll spend a lot of time today discussing some of these issues. So you'll have the chance to engage and discuss on some of these issues about how we predict the future and engage with the economic and business realities of our firm. So we'll move through. So we'll kick off now. We'll have a look at this video on forecasting net operating assets. Have you wondered what really drives the level of our firm's net operating assets? In this video, we look at how we can focus on the key economic and business drivers that are driving our firm's net operating assets. We know the various accounting drivers or numbers are not really driving the performance of our firm, but are themselves merely passengers on the journey. One aspect of a firm's past we need to consider before predicting the future are the economic and business drivers of net operating assets, the real drivers of our firm's net operating assets, or capital invested in our firm. Once we move from examining accounting drivers to considering the economic and business drivers of our firm, experience and ability to make sound commercial judgments become critical. The focus shifts from engaging with the firm's financial statements to engaging directly with the firm's economic and business realities. As each firm will be different, sources of information and how these assessments and judgments are made will vary considerably. But here are a few general principles to bear in mind. The key accounting drivers of our firm can help us focus our examination on the economic and business realities of our firm that are driving these key accounting drivers. We seek to connect the accounting drivers of our firm with its economic and business drivers. As we become more comfortable understanding these linkages, we can make judgments about how these economic and business drivers might change in the future, and to quantify the qualitative changes in these factors into accounting numbers and into measures of value. Forecasting net operating assets involves first forecasting the economic and business realities or drivers of a firm's net operating assets. We can then estimate the effect of the future economic and business realities or drivers of a firm on its future accounting drivers of net operating assets and so forecast a firm's net operating assets. Our identification of the accounting drivers of net operating assets for a firm helps to frame our assessment of the firm's economic and business realities. We focus on those aspects of reality that connect to the key accounting drivers of a firm's net operating assets. The key accounting drivers of net operating assets are sales and sales growth and asset turnover. We are interested in those aspects of a firm's economic and business realities that will affect its sales and asset turnover. Usually, a key aspect we wish to examine is a firm's sales. We can analyse what has been driving a firm's sales in the past. However, what was driving a firm's sales in the past has little direct relevance to the value of a firm. We need to engage with and make judgments about how the economic and business drivers of a firm's sales, and also of asset turnover, could be expected to change in the future. And we need to be able to convert these judgments into numbers, into the future accounting drivers of net operating assets, and then form a credible, convincing and intelligent forecast of net operating assets. For further information on forecasting net operating assets, go back to Chapter 5, Section 5.4 in the study guide. Also, review Predicting the Future weekly questions. Also, answer, write and rate questions in Peerwise. Okay, so here we have a look at the net operating assets, and if we, in terms of our measure of cash flow and economic profit, net operating assets comes into that. So what's our definition of free cash flow? Who'd like to tell me what free cash flow is? Just one at a time, no rush.
I'll give it a go. Isn't free cash flow the difference between financing and operating activities?
Well, it is the transfer. Yeah, that's right, between those two. And that's correct. And that is our definition of free cash flow. And what is the formula? What does free cash flow equal?
I don't remember off the top of my head, sorry.
It's sort of the formula that explains what you just said, those transfers. Operating income, which is, that's our measure of cash flow coming out of our operating activities, minus
the change in net operating assets.
Minus change in net operating assets. So if we're growing our net operating assets, then that's minus is a positive number, and that would be minus a positive number, which would be the transfer from the financing to the operating activities. So you can see how net operating assets comes up into our definition of free cash flow. And what's our definition of economic profit? Just one at a time, no rush, just take your time. Just one at a time. What's our definition of economic profit? Who'd like, or just tell us what economic profit is. Sarah, you can have another go at it, or Sharon, or anybody. Yvette?
I'm going to say that it is...
Introduce yourself when you say something.
Hi everyone, this is Sharon, Sharon from Rockhampton. I'm going to say that it is the return on equity.
We've moved into return on net operating assets, with our operating, focusing on the operating. Yep.
So it is the return on net operating assets less the required rate of return.
Yeah, or WACC, our weighted average cost of capital, which is our return
less the
of equity for operations.
Less the book value of net operating.
All times the book value.
Times the book.
So who would like to have another crack at that?
That's terrible.
Yvette, what's our definition of economic profit?
I think that Sharon did a good job there.
Well, why don't you tell me?
I like the formula take on it.
Yeah. Well, why don't you tell us, in your own words or by a formula, what's economic profit?
I don't know if I can really add anything to that.
Well, just say it again then.
Yeah.
Return on net operating assets minus WACC times the book value of the firm.
Net operating assets, yeah. We've shifted from a focus on the company as a whole to a focus on the enterprise. So we can frame that economic profit measure as return on net operating assets minus the cost of capital for operations, WACC, all times net operating assets. And so you can see how net operating assets and changes in net operating assets drives both cash flow and economic profit, and we'll be looking to forecast both of those for our firm. So net operating assets, forecasting net operating assets will be one of those, which in turn is driven by sales and asset turnover, will be one of the factors that we'll be looking at in forecasting our firm. And last week we looked at the accounting drivers more generally, which included return on net operating assets and profit margin and asset turnover as well. So those accounting drivers that we'll be looking at, we use them to focus our minds onto what's driving them in the past, what economic and business realities or drivers are driving those accounting drivers. And then as we identify those, they're what we'll be forecasting. And we looked at Ryman Healthcare, for example, some of those such as house prices. We look at forecasting those, and we'll have a forecast horizon for all our firms of 5 years. So we're going to forecast for 5 years, but then the issue is there's still plenty of value for a firm beyond 5 years. If we only forecast for 5 years, we're going to leave out a lot of value of our firms. So what do we do after our forecast period? What happens is as we forecast further and further for any business, we become more and more uncertain about what might happen. And there comes a point where you just can't really make judgments beyond a certain point. We're just arbitrarily saying 5 years in our unit. So that's when we get to the forecast horizon. That's the point where we can't forecast with much degree of confidence any further. So how are we going to handle that? How are we going to include in our value judgments around what happens to our firm that we expect might happen to our firm in the future? So that's where the forecast horizon comes from. And here's some pictures of Wellington in New Zealand. It has a beautiful harbour, and but it can often be very cloudy and foggy sometimes, particularly in winter. And then you can see much shorter distances. And then, so for some firms, they're easier to forecast. Ryman's has predictable cash flows in many ways, so it's relatively easy to forecast. That's why I prefer firms like that. Other firms are very difficult to forecast. And so there's a point to where you can't really see any further with a degree of confidence. But for other firms, Ryman's is a bit more like this. You can see further with a degree of confidence. So whether the forecast horizon is short or close, and we'll just be arbitrarily using 5 years now for all our firms, there always comes a point where you can't see with any degree of confidence any further in terms of forecasting. So we'll have a little look at the video forecasting the forecast horizon to discuss, and then we can discuss some of these issues. When valuing firms, we need to project economic profit and cash flows for eternity. If you are wondering how we might do this, in this video we will look at how we face a forecast horizon. We can only forecast economic profit and cash flows for a limited period. As we look out into the future, it becomes increasingly difficult to see the way ahead. we might be reasonably confident about our forecasts for our firm for the next year, less confident for the following year, and so on as we step forward in our minds into potential future realities for our firm. I live in Yeppoon, a town on the Capricorn Coast in central Queensland. We have beautiful views over the town, down the coast and across to the islands nearby. The skies are usually blue and clear. However, in winter sometimes a fog settles over Yeppoon and then slowly rolls out to sea. On these days there are no distant views, just a fog closing in and restricting my world to a few hundred metres in any direction. But then the fog will steadily lift and my world opens again to a wide perspective and distant views. Forecasting can be like this. Sometimes it can be most difficult to see very far ahead with any degree of confidence. It can feel like walking through thick clouds and fog in Yeppoon. The world can be a very uncertain place when you cast your eyes even a short distance away. At other times it can feel like having a clear view of a wonderful vista, able to see much further with considerable clarity and confidence. Whether we have a high or low degree of confidence in our projections, whether we feel confident to project many years into the future or just a few, we still face a common problem. It is called the horizon. Regardless of how far or near the horizon is, it will always be there. There will be a limit to how far we can see with some degree of confidence. Even with a clear vista down the coast, we will not be able to see beyond the distant points and hills of the coastline. It is the same with forecasting. There will always be a limit to how far into the future we feel comfortable projecting, a limit to how far forward we can see. Whether this is a few or many years, our projections of economic profit or cash flow will only be for a limited period into the future. Yet equity investors are entitled to the returns from a firm to eternity, or until the firm is liquidated or taken over. How do we engage with or understand what might happen to a firm beyond our forecast horizon, beyond the limits of our ability to forecast a firm's future? The way we deal with this issue is we project our firm's cash flows and economic profit for a limited period. When we can no longer make reasonable projections, we then calculate a continuing value. To find out more about continuing values, see the videos What Continuing Values Are, Benefits of Using Continuing Values, and Formulas for Continuing Values. Also see Chapter 7 in the study guide. For further information on forecast horizon, go back to Chapter 5, Section 5.4 in the study guide. Also, review the Predicting the Future weekly questions. Also, answer right and rate questions in Peerwise.
That's great. The story here in terms of forecast horizon is we'll be making projections for a limited period. For us it'll all be 5 years. Then we're going to calculate a continuing value at the end. We'll be looking at the details of that in week 11 in terms of the formulas and so forth. But that's what we'll be focusing on. So what we're focusing on at the moment is making those linkages of our past accounting drivers to what's been driving them in the economic and business realities in the past, and then forecasting those economic and business drivers for 5 years. And then linking back to our key accounting drivers to form a forecast of cash flow and economic profit for 5 years. And then we'll be calculating a continuing value at the end of 5 years to include our judgments about what happens beyond that forecast horizon. It's often those judgments actually in the continuing value that can be quite critical to a quality valuation compared to one that's less convincing. All right, so that concludes the input on forecasting. We've got some questions. We've got a series of questions I'd like you to have a crack at. The first one, and then we'll discuss it. Financial statements are a record of what a firm has done in the past. How can analysis of financial statements be focused on a firm's future? How is this possible? How is it possible to use financial statements which are firmly in the past to help us forecast our firm's future, to focus on that? Write down a few comments that you might have about that. Thoughts, questions. I'll give you a couple of minutes, 2 or 3 minutes or more, and we'll see what you have to say. And we've got one comment so far on the first question. Anything else? Just one. We'll wait another few minutes for some further comments. I've got 2 now. We've got 5 responses. Oh, Maria, would you like to take us through these responses?
Sure.
People can keep adding them in, everyone, but let's kick it off. Thanks, Maria.
That's all right. We've got 6 in that I can see anyway. So I've been reading them as they've been coming in, and I think a lot of them are fairly spot on, Martin. So I'll start reading them just because in understanding how the figures reflect what has happened in the past makes it possible to make assumptions as to figures may reflect what could or should happen in the future. And similarly, you need to understand the past and the key accounting drivers of a firm before diving into an analysis of forecasting a firm's future. By looking into the past and seeing if the strategies that were planned came to, by breaking down the financial statement and finding the key drivers, using the drivers making a guess based on the drivers of the firm. It's a best guesstimate, I suppose. As Martin put it in the video, hopefully it's an intelligent forecast. You can find the accounting drivers, numbers that stand out, and then relate them to real-life company actions. Oh, this is getting even more scary. Most companies give some indication of what they are doing in the future. You can then link this future with the accounting drivers from the past financial statements. Looking into the past, we can see trends. We can look at the trends to see what is driving them. From there, we can look at the drivers to see if they are going to change or continue in a similar path. We can then attempt to predict the trend and therefore the accounting outcome. It is a circular exercise. Wow. Best guess for the future via past financial statement. I think some of these, Martin, have done a better job than what I think I could explain it.
Yeah. So there's a sort of a sense that there's some agreement in the idea, or at least are repeating the idea, that there's value in looking at the past. That the accounting drivers, it hasn't quite been said, but it's sort of implied a bit, that the accounting drivers help us focus. So we've got these key accounting drivers: return on net operating assets, profit margin, asset turnover, sales growth, net operating assets, and seeing what's driving those in the past and understanding some of the connections to the real world can be helpful in making assessments about the future. And some of them are, and also what's being said in those, which is great, is that just because something's occurred in the past doesn't mean it's going to happen in the future. But engaging with the company's real life actions and strategies in the past and what they're looking to do in the future, they might be changing some of their strategies. There could be all sorts of things that change in the future, but it's hard to make those judgments until we understand those linkages between the accounting drivers and economic business drivers of the past. Seeing trends and deciding whether they can change in the future. So people were the comments were sort of saying, yes, it is possible to do this, or were you just commenting on what's in the reading or the videos? What do people think about how confident are you? Is this something that seems possible to do? That you can connect to what's driving these accounting drivers and make forecasts of them that are going to be worthwhile? What do you think?
Yeah, sure.
Sharon said, yeah, sure.
Yeah.
You got no choice with the unit, you got to do it.
You can make better estimations with a better education, basically. That's why I'm here.
And if you've considered your firm and some of the issues, and you've got a bit of, Sharon's doing South China Air.
Yeah.
And so Chan, who's here from China, he'll be able to help you with a bit of local knowledge.
I have no idea what goes on over there.
So that'll all help a little bit. Obviously, there's limits to the context you can understand, but nevertheless, airlines. Are there any more comments on this question that you'd like to make?
There was one more.
Sorry, Maria.
7th submission. So the other comment was the financial statements can show what the firm is doing. It can show us what assets are being used to generate sales. Their focus on research and development to give us an insight into their future activities, their business practices involving remuneration relating to business performance and expectations. We can see the results of past strategies and glimpses of future strategies. We can see how a firm responds to past issues and their strategies to combat issues in the future.
Very good. Excellent. So we can see, for example, with Ryman Healthcare, they've been very good at making their shareholders rich in the last 20 years through various strategies, and so that can help us to form a view of that going forward. That's great. And that is true. There are embedded stories in the accounts. There's a lot of subtlety to this that we're not getting into in this unit, but there's embedded in the accounts is a lot of are a lot of forecasts of the future and a lot of judgments and a lot of viewpoints. And so there are quite a few elements pointing to the future, which that last comment was making. All right, so that's sort of the framework of how we're thinking about it. Let's have a look at the next question. What are the main differences? What are the main differences between drivers and passengers?
Martin, we've got a fire alarm going off, so we'll be back when we can come back.
All right, thank you. Do you think that the financial statements are passengers and that a firm's economic and business realities are the drivers? Why or why not? Passengers and drivers. What's this distinction, and can we fit financial statements as passengers and economic and business drivers, or realities as drivers? Why or why not? We've got 3 responses. Well, Maria, while we're waiting for some more to come in, do you want to start kicking us off on these, the first 3, and we'll keep writing them in. We've got 4 now.
So drivers are those that are actually steering or affecting what is happening with the travel of the firm, while passengers are only reflective of where the firm has gone. Hence, why financial statements that are the numerical statement of the last year of a firm's activities can only be passengers.
That's good. That's a really good description of that.
Yeah.
This distinction between drivers and passengers, if you understand this and have it in your head after finishing an accounting degree, you'll be 1 in 100. You'll be 1 in 100. It is so easy to focus on the numbers and to think that they're driving it. It's so easy to do. Anybody who hasn't studied accounting, they don't think like that. It's only people who study accounting, only accountants. We get so focused on the numbers, and you'll see this when you're analysing your firm. You get so focused on the numbers, you forget that the numbers are just the passengers. We don't care about the numbers, we care about the business. And it's those economic and business drivers. In other words, it's the stories the accounts can tell us that we're interested in, the stories about the business. That was great. Oh, Marie, do you want to keep going?
Yeah, I really like that one. Passengers can't make changes or impacts themselves. Drivers can. Financial statements are passengers because it is just a reporting of the last year. Economic and business realities are what create the statements in the first place. It's another good one.
That is good. And of course, that's true that the economic business drivers create the numbers if the numbers are accurately reflecting what is going on. Is it true that the accounting numbers reflect accurately what's going on in the business?
Sometimes.
Oh, Sharon said sometimes.
Yeah, but sometimes there are unethical practices. People make mistakes.
People make mistakes, that's true. A lot of mistakes in accounts. And if you look at your accounts year on, year out, if you look at your, you know how you've got 2018 and 2017 figures in your 2018 annual report, and then you look at the 2017 figures in your 2017 annual report, often some of the numbers can be a little bit different.
Yeah.
Have you noticed that? Have people noticed that?
Yeah.
So why is that?
Adjustments?
Adjustments. Well, one
last minute surprises.
Not that last minute. Yeah, so in other words, the accounts are continually changing, aren't they, after balance date for errors or new information. So, and if they're only on the margins, that's fine. And you can see how in a lot of the listed companies you'll see that. If they're big differences, that's not good. People go to jail and stuff because you're misrepresenting the company. But if they're marginal, immaterial differences, it doesn't matter. And you just keep correcting them. So, yeah, so that's assuming that the accounts are reflecting what's going on. But we know that there are a lot of judgments in accounting. I think we've emphasised that. A lot of judgments and the ethics. In accounting, there's ethics. People sometimes say, well, what are the ethics in accounting? Well, the ethics in accounting are that the judgments being made by management and the accountants, so the accountant's role is to ensure that the judgments being made are accurately reflecting what's really going on. So in order for you to be able to do that as an accountant, you need to understand your firm's business. Just like we're looking at our firms now, but inside. Oh, somebody's got their mic on, might be in Mackay. You've got to understand your own business. A lot of accountants don't do that. They're so busy looking at the numbers. This is what bean counters, which is a derogatory term, I might add, that people use for accountants. They're just focused on the numbers. They're counting beans. No one cares about how many beans are in the jar. What we care about is what they're telling us about the business. So you'll see this when you're working. I would notice with a lot of people going into the Big Four, for example, they'd often do auditing and this sort of stuff. Very focused work in their early years. And they'd often come back to me and tell me, you'd work in first year out, you'd work with a person who was in second year out. You sort of go up the chain a little bit. And they're saying, man, the people I'm working with who did the audit last year, they don't know anything about the business. They're just doing the numbers. And they don't mean anything to the person doing it. How can you do an audit if you don't understand? See, so they've lost it already. They're only their second year out. They're just focusing on the numbers and it's a bit of a game and I don't know what it is. And so, but of course, if you're interested in the business, you're going to be seeking to connect to it and seeing what the numbers say and that the numbers are reflecting. This is critical in our capital markets, in our listed markets, in our capital markets. The accounting figures need to be connected to what's really going on in the business. If they become too disconnected, then all these decisions for capital allocation and so forth are all going to go haywire. And there's a lot of regulation in the West, in the capital markets. It's been in place since, or America started doing it after the Great Depression, and to try and restrict the degree to which people will be making judgments that are not connected to reality. That's what ethics is about in accounting. It's the role of the accountants to ensure those judgments are being made in a way that reflects reality, and you will need to stand up to management from time to time. And you better know your business and be making sensible judgments, otherwise you'll really irritate management. But sorry, I went on about that, but there's some interesting issues around that. Sorry, Maria, back to you.
Okay. So we've got drivers are the direct influences and the change agents that are affecting and changing the business and economic realities. Passengers are passive and are just a reflection on what is happening with the drivers. They are just along for the ride. Financial statements are the passengers.
Just to interrupt again on that, that's good. And you can see that is, you can see a lot of what we're saying around that is presupposing that the accounts are reflecting reality. And that's a critical part in accounting. Sorry, go on, Maria.
Yeah, so passengers are just a reflection of the economic and business realities that are driving them. The main difference between the economic and business drivers and the accounting drivers is that the accounting drivers are just recording the economic and business activities. The real motivation are the ideas behind these activities. I do think the financial statements are passengers because the economic and business activities are the real drivers. The business is the vehicle. Drivers do need to control the direction of the business, and the passengers just follow the goal that drivers made. A driver does everything in a car while the passenger is just a distraction for the driver. Would be a good analogy. Do they really reflect the reality? Yes, the financial statements are drivers and economic realities are the drivers. So financial statements are passengers, I think that's supposed to be. And the economic realities are the drivers. Because financial statements can be manipulated while the economic realities not. And the last comment is the economic and business realities are the drivers of a firm, while the financial statements are just the passengers along for the ride. This is because the numbers are passengers and the business is the most important thing and ultimately drives what is happening in a firm. That's all of them.
That's great. Well, everybody has said they think financial statements are passengers, I think. Perhaps qualified a little bit by whether they're accurately reflecting what's going on. And it's the drivers that we're focusing on. So that's a key concept we've been looking at. This is your mission now, should you choose to accept it. You have no choice, says the assignment. Is to use, and you can see to experience whether or not the accounts can be helpful to you to focus on what's really driving value in your business, So Ryman Healthcare makes great profit margins. One of the reasons for that is house prices, rising house prices. And there are other factors, of course. All right, that's great. Let's move on. We'll move on to the next question. Here's a quote. There's a range of views on a lot of these things we're discussing. So I'm very happy for people to have a range of views. I mean, we've got a structure that we're working on in the unit, but it's very open. I enjoy hearing a range of views, and there are a range of views in the financial markets and in the profession. Financial statement analysis should focus on analysing financial statements. It should not. Financial statement analysis should analyse financial statements, the actual numbers. It should not involve assessment of vague, confusing, and hard to pin down qualitative factors that surround a business. We need to get to the facts, not to people's judgments. Do you agree or disagree with this statement, and why? Give you a few minutes to think about this. Okay, Maria, would you like to take us through these ones? People can keep writing. There's quite a bit to this.
Sure. All right, so I'm seeing 4 submissions. I disagree. While other people's judgments do not necessarily help in establishing the reality of a firm, if you are looking to invest, you need to make judgments about the hypothetical future. And another one, I disagree, because to do the analysis of a business, we do not need just the financial statements. We need aspects that surround the business. We need to understand what is driving the business and what environment it is in to do a good analysis. And another one disagrees. Financial statement analysis involves a degree of analysis of the financial statements themselves and also some judgments, especially when it comes to something like forecasting the future from a firm's financial statements. Then we have an agree somewhat. At the end of the day, the financial statements can be manipulated. Close enough is good enough, as the statements are the only real information we can get about a company without running it and seeing the internal workings of it. A company might say they are going to do something in the future, like buy more property to build retirement homes on, but the only thing that is certain is uncertainty, and the only things we can be sure of is the past. That's a fairly insightful statement. Then we have two.
Who said that one? Who made that comment?
It was the agree person, the agree somewhat.
Agree somewhat.
That was me, Martin, Yvette.
Yvette. So do you want to flesh that out a little bit more?
I can. I just think that with all this financial statement analysis, we can make these great judgments and everything, but at the end of the day, we can't. You're never going to be 100% certain, 100% perfect. And I think, at the end of the day, although we might try our hardest and make all these connections, you never know for sure what's going to happen in the future.
That's great. You can't be 100% certain. In fact, the one thing you can be certain, which I think you might have said in your thing, we can be certain we'll be wrong. Whatever forecasts we're going to make, just imagine if you forecasted even a week ahead and said, look, this Saturday afternoon at 2:15 I'm going to be doing X and Y and that. It probably won't happen. If it did happen, you'd go, whoa. It's sort of like that, isn't it? So our projections are going to be wrong, aren't they, to varying degrees? We're going to be predicting a future that never happens, exactly as we think. So what do you think about that, Yvette?
I think that's pretty spot on.
So does that mean it's... Sorry, go on.
I was going to say, if this was hard, fast and scientific, anyone would be able to go out there and invest their money and make a great return because they'd be able to completely forecast the future to a T. Because that doesn't happen, I'm more inclined to think that it's not as easy. There might be a few really lucky people or really skilled people, but as a whole, I just don't see it,
That's right. So it's obviously, it's not as simple. What you're saying is it's not as simple as plugging in a couple of numbers into a formula. If it was, there was some thinking that there's been a lot of research around that going. I've referred to this, I think, back in chapter 3, the study guide. There's been a lot of research since the 60s when we had computers. We were able to sort of backfill data, and so we could look to see if there were relationships between certain ratios and the future share prices of companies. You could sort of go back 10 years, look at their ratios, and then look at all the... You could do it with a whole heap of companies. You could do it with a huge number of companies. And they did this. They spent about 20 years trying to do these things, and they found nothing. So it's sort of what you're saying. It's not that simple. And the key at the heart of financial statement analysis is the connection between the accounting drivers and the economic and business drivers. It's those judgments. That's the thing you get better at with Bull. I found people can do it, actually. All sorts of people can do this. But so that's great. And I think what you're sort of indicating there a little bit is that the accounting drivers, at least I'll ask you your thoughts on that and others, the accounting drivers, looking at these, we've got an economic framework. We've got economic profit and cash flow frameworks for valuing and considering value creation in our firms. So they are sort of lenses, or our way of thinking about it that we're using. They're two very common ways of thinking about it. And we looked early on at how they're connected to the view of value in a business being the cash flow the investors will get out of that business, the dividends, over forever. So there are ways of operationalising that. So we've got this framework, and that drives us into looking at return on net operating assets, profit margin, asset turnover, sales growth, and net operating assets. And so we can focus just on those aspects of the accounts. And that can really focus our minds. And what I find happens, and I've seen this happen with a lot of people too in teaching it over the years, is that as you do that, just things come to your mind. You think, well, what is causing my firm to have such low profit margins, or to have, why is its sales growing so strongly? And if you've looked into what your firm does and considered its strategy, got a bit of a sense of the industry, and also you are talking to other people, making these judgments on your own is a fraught issue. But you just talk to people, each other about it, or anybody. You can talk to people. You get some you get some ideas come into your mind as to what those connections will be. Well, that's interesting, Yvonne. That's good. Sorry, Maria, I'll go back to you.
That's right. There's just two final comments, and they are disagree comments. So I disagree. Useful financial statement analysis involves analysing all the information available. Quantitative numbers also involves vague, confusing, hard to pin down factors, as there are many judgments that influence the numbers. By examining the qualitative factors, we can develop a better picture of the business reality and increase our degree of confidence for the future.
That's really good. There's some insightful comments. And one of the whose comment is that? Who said that?
That was mine.
That was Sharon. Sharon here in Rockhampton. And you can see this quote presupposes that the financial statements are facts. They're numbers, so they're facts. Well, they're numbers, but they're not facts. Profit is not a fact. Profit is a construct. It's a made-up number, and it's full of judgments. We could come up with a range of different profit figures for our firm based on making... for example, we had Act 11081 yesterday morning. Maria was teaching us about depreciation, and there's many ways of measuring depreciation, which can, for some firms, be quite a big item. And depending on the judgments in that, you can shift your profit around quite a bit. So that's some interesting comments there. Maria, do you want to continue on?
Yep, there's just one more, Martin. So it's another disagree comment. The financial statements are, to a degree, someone's estimates and judgments. Analysing the financial statements is an important part, however, should not be the focus. Even though looking into the future has its difficulties, it seems intuitive that it is better to be proactive rather than reactive. Looking into the future allows us to be proactive. In terms of valuing a business, I believe that such proactivity is important.
That's great. So there's some expressions of views and thoughts. Everybody's going to have a chance to test out some of this with your company, and in the harsh light of reality as to what is possible, what is doable, how are things going to work. Does anyone have any more comments on this they'd like to raise? If not, we'll go to the next question. Why do you think so few people can use a firm's financial statements to meaningfully assess its value? Most people look at a financial statements and it's just gobbledygook. It's just like, man, what is it? They just completely can't connect to it. What do you think are the main barriers people face in using financial statements to meaningfully assess its value? This can apply to accountants as well. They're just stuck on the numbers. What barriers do we face, or do people face? What do you think are the main barriers you face in using financial statements to engage with the realities of firms, of your firm? Because this is the task we will have ahead of us in the coming weeks. What barriers do you think you face? We've got 2 responses so far. We've got 3 responses. Maria, do you want to kick us off?
Sure. Excuse me. So few people do so because the time and effort required to assess each potential firm for investment exceeds what would likely be had unless working in the area of investment. Moreover, without an explanation of the process that relates the figure to the facts, it becomes difficult to get value from the process. I agree. It's the big thing I'm reading in that comment is time and effort. Who has the time? And like everything, anything worthwhile in life takes time.
That's some very good comments there. Who said that?
What was the first one?
I said that, Sarah.
Sarah, wish you the time and effort. It is. This is a very. There's some related questions to this. obviously we can't analyse a whole lot of firms. You can only do a few. So how do you pick which ones to analyse? Is one issue around this. And it's identifying firms to have a look at. You can't look at too many, can you? And the other key aspect of this is that if you've got a good grip on, you've got these conceptual frameworks we've been looking at, and you've got a good grip of that, it really focuses your mind on what to look at and also what not to look at. Even looking just at the operating activities rather than financial, you've left out a whole lot of stuff you decide not to look at. And then within that, we're just looking at what is driving some of the key accounting drivers, which are key accounting ratios of the firm. And so that can really help us focus in. So that's a real power of this sort of what we're looking at. But that's right. There's a quote from George Bernard Shaw. He was a playwright 100 years ago, and he said, most people think for themselves once a year. This is George Bernard Shaw, I've made a career for myself by thinking for myself once a week. So it's that mental effort is a real barrier for a lot of people. A lot of us don't want to think, until you get into it, then you do want to think. But, you just want someone else to do the thinking, or you just want to follow, or you just want to predict share prices. And these are very common views in the market. So I'm not criticizing, there's many ways of thinking about this, but there's the mental effort, isn't it? And thinking for myself, making these judgments. Some people really like doing it, but, it is time and effort. How do we do that in a practical way? So, yeah, there's some good issues there. Maria, back to you.
Yeah, so the next comment is a lack of knowledge and interest, seeing how people have a program to do it for them, breaking it down so that they can understand what the financial statement is telling them, not knowing the industry to see if the plans that the firm has made will become reality. So fairly similar. If you look at a statement as a standalone document, you can't make any comparison. They are just numbers. If you are given a number, how can you judge if it is good or bad without comparing it to other numbers or realities? This is what I faced the first time I analysed financial statements. I also think another barrier is free will. The statements are a reflection of the actions, but the actions are done by real people who have free will, which is unpredictable. If we accept that accountancy is the language of business, then we should let the numbers talk to us. By listening to the numbers, we gain an appreciation of not only the accounting drivers, but also an indicator of the economic and business drivers of the firm. In this way, a firm can be viewed as a living organism that is subject to constant change. So I'm hearing change, unpredictability, sort of different barriers to the time and effort that we saw in the first two comments. Comment 5, so few people can use financial statements to make meaningful assessments on a firm's value due to the complexity of what is involved and to make judgments of a firm. The barriers they will face include knowing what a firm's economic and business drivers are. That's true. These are also the barriers I will face when I dive deeper into my firm's financial statements to engage with the realities. And comment 6, I think few people have understood how financial statements work. Even after studying accounting for the past 6 years, I forget basic accounting principles and things change all the time. The main barriers people face are their predisposed ideas, their own bias and judgments. I think the main barriers I face in using my firm's financial statements, engaging with the firm's realities, are the continual barrier, continential barrier. I think it's supposed to be a continual barrier. The cultural barriers and wading through the barrage of information to find what's useful and managing to find the time to do it. So that one that last comment consolidates a few of the other barriers that the previous comments outlined.
Oh, that's great. Also, the last quote was talking about how we can have biases and our judgments can be skewed. We can over estimate what's happened in the past and think it'll continue. We could get very optimistic about our firms. We could get very pessimistic. So there can be a lot of biases psychologically in our judgments. There's some very interesting material around that. Anyway, we'll all get the chance to do it. The financial statement analysis is a common capstone unit in accounting because it gives you a chance to pull together what you've been learning in accounting, but also in your other business disciplines, and start to integrate it and review. You can think back what you learned well and what gaps you might have. You can strengthen your whole, and you can make some assessments about what you think about some of these types of issues. Again, people can have a range of views on all of these, which is fine. It's fine. And we're going down, you're going to do an assignment in a certain way, but people can have a range of views about how effective this is. So you'll be able to make some assessments about that as you do operate with your own firm and interact with others. But in terms of judgments and biases, I'll make a prediction. I'll make a prediction about the future now, is that the quality of people's judgments, the people who are interacting well with others already, will make much better judgments than people who are doing it on their own. I've seen this so many times. The quality of judgments improves enormously if you're interacting with other people and throwing around ideas. You'll help other people's judgments and you'll help your own. And that's one of the key areas. And that's why in terms of employability, as employers, we look a lot for, it's those softer skills, and particularly the ability to work effectively with other people are so important in so many areas. And one of the reasons is in order to make all sorts of judgments. They can be quite small things. You've got to make all sorts of little judgments and bigger ones. And it's the ability to interact with others. And increasingly that's online. And so, increasingly online. And so you get some opportunities in this unit to work on that and think about those sort of issues as well. And that's a question, you can think about this whole issue of barriers that you might face as you're addressing your firm. Well, I think there might be one more question. Without sales, a firm is dead. It will fail without sales. Thus, there is no such thing as bad sales growth. The only bad sales growth is no sales growth. Critically discuss. What do you think about this? Sales growth. Relationship with value. We've got one response so far. Mary, do you want to kick off? We'll start this discussion with the first one and then we'll continue as more come in.
Sure, we've got two now. So for sales to grow, I think that's supposed to say. For sales to grow, for growth to be good, it needs to actually increase the number of sales at the same value. If the growth is the result of lower prices for the same costs, then there is not an actual growth in value for the firm. Second, as you have said, that there is bad and good sales growth. Bad sales growth can be sales made to reach a goal short term that will affect the long-term sales growth. Third comment, technically that is true. Firms rely on sales to exist. To assume there is no such thing as bad sales growth is unrealistic. Not all sales create value to the firm. Some sales can erode the firm's value. Fourth comment, I think a firm is dead when it can't cover its liabilities as they fall due. Sales growth that causes ATO to decrease is bad. There's a few allusions to your video from last week, Martin, about good and bad sales growth. And then there's a comment number 4 refers to cash flow. I think a firm is dead when it can't cover its liabilities as they fall due, talking about liquidity as well.
Yeah, there's only one way to go bust in business, just in your personal life as well. It's to run out of cash. As long as you don't run out of cash, you're going forever. You know? So you don't need to make a profit. That's great. The lower prices, same cost. You can have sales at lower profit margins, still add value. And you can have sales and have falling asset turnover and add value as well. You see, what happens is, in marketing, for example, it's a bit like with accounting. When we study accounting, we focus on the numbers. We forget about the business. You know. In marketing, you can focus on just on what the customer wants, you know, and on sales and sales growth. Give the customer what they want. And, well, it's not quite so simple. You know, you do have to focus on giving the customer what they want, but in a way in which you make money and add value to equity investors and to the firm as a whole. And so if you're studying marketing, we've got a framework here that helps focus the relationship of sales to adding value. That's the sort of sales we want. Some customers are better than others, you know. We want to focus on sales that add value. And so our economic profit model, for example, and the discounted cash flow model, but the economic profit model helps show us, and that's in that excellent video on good and bad sales growth, which, you know, if you're interested in marketing and focus on marketing, watch that video a few times. If you can connect to the idea of adding value through sales, that's exactly the sort of strategic marketing that we look for in businesses. And you can see how the different disciplines interact. So think through those issues more. It's that the model gives a very focused view on how you can assess good and bad sales growth. That's great. Well, I think that brings us to the end of our time. So let's do the minute paper. We have to do the minute paper so quickly. You can have 1 minute. I'll give you 30 seconds. What was the most important thing you learned today? Maria, you can kick us off on this discussion on the first one while people are putting them in. We've only got like a minute left, I think.
All right, we've got 2 comments. The most important thing we learned today. I learned that while we are only looking to make a prediction for the period that we feel reasonably confident about in the act of investing, the prediction is then tied to earnings for the firm's eternity. I'm a little bit confused by that, but...
Oh, no, I understand that. That's great. So you can see some of the challenges involved, yeah.
And then a recap on bad sales growth is the second comment.
That's great.
That's all we've got in for those 2.
We've got a third one.
Third one in. Let's go. Forecast horizon.
Yeah, that's another key important concept. And so we've got the structure of how we're going to go forward. And now you can give it some life as we look forward. We'll look at continuing values, which is how we value that bit of value of our firm beyond the 5 years. We'll be looking at that in week 11.
I like the one. Profit is not a fact, it's a construct. It can be manipulated. Accuracy depends on errors, availability of information, and changes in accounting practices. Fantastic. That's great.
That's right. That's excellent. Excellent. And any questions? One question.
I wonder if I will miss key drivers of the changes in my firm since a service provider doesn't use assets materially the same way they say a clothing firm might.
Some interesting points. We'll be talking about some of those issues in the coming weeks with the different firms.